How did yesterday change your base case for 2024?
Well, I think the discourse needs to change. Since the November 1st FOMC meeting, we've observed a massive easing of financial conditions. Stocks up by about 25% on average, with fairly broad participation in that rally. 10-year yields fell peak to trough by over 100 basis points. And also credit markets. If you look at single B spreads and high-yield bonds, just over 300 basis points, within 50 to 60 basis points of the all-time tights of that time series dating back since 1996. So this response in financial conditions since November is actually looks reminiscent of what we saw when the Fed launched rounds of QE in the past decade. And I think that, it's not the base rate, which has remained unchanged, that's so central to inflation determination, but of course these broader financial conditions. So I think today the Fed has to look at these data, look at a services sector that looks to be bursting at the seams, just as the demand in experiences, entertainment services continues to grow, and really just change this discourse to think right now that, looking forward, we don't see any rate cuts. And then I think you can allow for a tightening of financial conditions that may eventually, by year end, put you in a situation where you're feeling more comfortable on the inflation front.
Jason, what I hear from you is that you think we need tighter financial conditions. The Fed chair says we are sufficiently restrictive. Do you think we are insufficiently restrictive based on what I'm just hearing?
Well, of course. I think, again, as of November, the Fed said that they didn't need to hike further because financial conditions had tightened sufficiently. The market effectively did the Fed's work for it. And I think that was right at the time. But again, when you look at whatever metric one wants to look at or collection of metrics to try to ascertain where financial conditions stand, it's hard to say that through the first 3 months of this year, you had tight policy. It's not the base rate that matters. The Fed funds rate is an overnight interest rate that is applied to about $85 billion of transactions. It's meaningless. It's only the extent to which those instruments, the balance sheet, the base rate, guidance, actually influence financial conditions. And again, on that score, you would have to conclude that policy has been too easy to hit a 2% inflation target. And I think that gets into questions about, is the Fed, effectively, implicitly moving to a higher target? If the discourse doesn't change, I think that is going to be the takeaway among many market participants.
Which certainly is what we're seeing and hearing in all the notes overnight as people look at maybe a 2 to 3% range for the potential for inflation. As an investor, though, when you take a look at how easy financial conditions have been, do you push against that? Do you sell credit? Do you avoid those areas? Or do you lean in and say, this is a Fed that wants to remain accommodative and that wants to run this economy hot?
Well, I think running the economy hot, may turn out just fine. The economy is performing very well. Earnings growth looks very solid. I think the risk in the situation, however, is the federal budget deficit. And what I mean by that is some market participants may conclude that the Fed is not moving to a higher inflation target willingly. It's actually succumbing to fiscal dominance. And it's now setting policy based on the funding needs of the Treasury, setting policy so as to limit the Treasury's net interest expense, which of course has been growing explosively. And if that happens, if that is a broadly shared sentiment, watch out for long-term bond yields. Because if a central bank is setting policy, again, on the basis of what the Treasury, the fiscal authority needs to fund itself, it loses control of the price level. Again, these are tail risks. This is not anyone's central forecast. But as these perceptions gain hold, you could be looking at much, much higher long-term bond yields and a much steeper curve. So for me, in this environment, I really like floating rate loans, CLOs, where you're actually profiting from riding out these base rates. As mentioned earlier, that this idea of needing to buy bonds because they, go to 4.5% or 6% in some investment grades, let's lock in these yields now. That's proven to be a bad trade. And I think there's a lot of embedded duration risk that people need to be cognizant of.
Jason, you have a lot of proprietary research overseeing all the portfolio companies at Carlyle. What's your understanding of what benchmark rate becomes restrictive for these companies? At what point these higher yields really do pose an existential risk to their business models?
Well, I don't see existential risk, but what I would say is that over the past several months, and certainly much of 2023, the expectations of rate cuts and the expectation that the terminal rate is still much, much lower than current levels of the Fed funds rate allowed a lot of businesses to swap 2-year, 3-year to 5-year and lower their borrowing costs. So again, it's not the overnight rate that matters. If you had a flat curve at 5.3%, or if you had an upward sloping curve from 5.3%, that would be more than sufficient, I think, in my view, to bring inflation down to target. So again, it's not the base rate that matters here. Secondly, I would just say that one of the effects of higher interest rates that's been interesting is, of course, increasing finance costs. So it's more difficult for consumers, of course, to buy homes, but also durable goods, renovations. So what's happened is the spending has actually moved to experiences, to services. And again, this is precisely where the inflation is. If you look at household balance sheets, what you find is about 85% of the debt is fixed rate. Almost 3/4 of that is of course, long-term mortgages. The effective interest rate being paid on that $13 trillion stock of mortgages is still only 3.8%. So you have the rate hikes have done nothing to dent household cash flow. So households on average are still able to spend with the growth in compensation. Again, because of higher finance costs, it's meant that spending has been redirected into experiences.